Hello, everybody. Welcome to Friday, another Talk Money with Tom show today. Really glad that you could join us. This is our last show of the year, actually, because the next two Fridays are Christmas Eve and New Year's Eve. So the next time we see you will be, the first week of January. And so this show is about trying to help people have a more successful retirement. Whether you're looking forward to retirement or already in retirement, we try to cover questions that can really help almost anybody in this particular area. This is a question and answer show. And so if you want to send in questions, you can do that right now at this Ask Tom with Talk Money with Tom email address that you see right here on the screen. Ethan gets those, or you can put the question in the chat. We get those questions during the week, and we've gotten some questions already. And sometimes I share questions from some of our strategy sessions that I have with clients that I think are important for everybody to know. So hopefully you get something good out of this. That's our main objective. And so if you're interested in kind of continuing to get the content and develop your knowledge base in the kind of retirement planning, tax planning, investment management areas that we cover, you can hit that little subscribe button that you see there. Hit the little bell right next to it if you want to get notified when we do post, and we post every day. Basically, if you're interested in just trying to talk with us, you can go to the website, which we also have the link there for our business, and hit the book appointment button. Just set up a 30-minute, phone or video meeting, and we'll help you with whatever it is that you might have on maybe a more custom basis. So anyway, look forward to the show today. Look forward to being able to talk to you about some of the things that are happening. I do like to start off the show just quickly talking with a summary of kind of what happened this week in the stock market. I'm going to do it a little bit different, though, because this is the last show of the year. I really want to talk about kind of what I see happening for 2022. And this is an unbelievable time period right now, unprecedented. We have a variant right now that is doubling in number of cases every 2.5 days here in the US. We have the Federal Reserve actually starting to do things, cutting back on bonds and starting to talk about raising interest rates. We have a scenario where inflation is very high. We have high demand. We have supply chain issues. This is not anything normal about this particular time frame. Because of the pandemic, this is not a recovery out of an economic downturn. This is a reopening, which is a completely different animal. So really fascinating time frame. So here's the first piece of information that I'd like to share with you. I read an article. The author had gone back and took a look at, the S&P 500 year by year, all the way from the end of World War II to now. And what he found was that in every year where there was a 20% return or higher, which is what we should end up this year, the next year was up an average of 10.4%. So that's pretty good. Not 20, but 10.4 is right around the average for the S&P 500 long term. But more importantly, he found that the market was up in that next year 80% of the time. Okay, so that's one base case situation we have to think about here. If you think the market's going up next year, you're 8 out of 10 times you're going to be right, at least looking at history. And I feel pretty good about that, actually. At this point, when I'm looking at kind of what I weigh as the negatives and the positives, I still think the positives outweigh the negatives, and I wouldn't be surprised at all to see a positive rate of return next year. So that will happen, and we'll see what goes on. I don't react to predictions as much as reaction, kind of see what happens. But the next piece that I'd like to talk about is just kind of the way we manage money is interesting, I think, in the sense that we will take the allocation that we have for stocks in somebody's portfolio, and that can go from anywhere from 10% to 100%, and we have basically 10 models, 10% differential between each one. And we'll take a look at that and we'll say, okay, 75% of the allocation that we have in stocks, we traditionally have in these very broad indexes. So we just want to participate in the market, especially if it's going to go up, like it hopefully will next year. And so, the Vanguard Total Stock Market Index, the S&P 500, those type of things, just try to capture everything as far as that goes. And we don't have to guess there. If it's small caps that do well, we got it. If it's tech that does well, we have it. If it's value that does, we have it. Everything's in there. Matter of fact, there's thousands of stocks in those exchange traded funds, which is really nice. So then the next thing we have though is this, the rest is the 25%. We have these little targeted indexes. And that's where I'm trying to kind of find trends, where I'm going out looking for, I look at it like waves. I'm sitting there looking, for a wave to come. I want to ride that wave in for some period of time, longer the better. And so when we're looking at trends, we're thinking about the themes and what might change and why this might do well. And then I go out and see if it is moving. If it is, I often jump on that trend. But here's what I'm seeing right now. I like to kind of go through mentally and try to figure out different themes that might happen coming up here. And I can make up more themes right now than I ever could ever. Just take the Omicron variant. So for example, we could look at next year and say, hey, it turns out that it's pretty mild. Combine that with the Pfizer pill, the antiviral that currently just finished its final trial with an 89% effectiveness against keeping people out of the hospital. Let's say it is mild and it affects more people, gives them some immunity, combine that with the Pfizer pill. Wow, that's a totally different story for what could happen next year. And we might have even more demand coming out because obviously people would like to do more in that situation and travel and do all these things. And we could have a booming situation, which could cause some inflation, and then how does the Federal Reserve deal with that situation? On the other hand, you could have a scenario where this Omicron variant slows things down. So I just read an article this morning about London restaurants that are closing down for the holidays, where they make about 40% of their revenue because they're getting too many cancellations. The big Christmas parties are being canceled, and because people are afraid of the Omicron variant. And obviously right now it is spreading quickly and we're not positive what the end result's going to be. And so if you go through the year like that and you have a bunch of slowdowns, well, then you're probably not going to have much inflation in that environment. The Federal Reserve would maybe not raise rates as much and might even slow down their bond purchases, right? So that's happening. You can look at the kind of the bond market is kind of, they're looking right now, when you look at the bond market, the yield is not coming up a lot. And to what that generally signals is that they're looking at an economy here in the future that isn't that hot. So again, those two scenarios are exactly the opposite of each other. There would be totally different things that you would invest in, most likely, in each one of those situations. And I can keep going, and there's just scenario after scenario. For example, there's a big assumption right now that because the demand's so high, that the Federal Reserve is behind the curve. They're going to have to, continue to raise rates and even raise them more than they're already talking about. And so, again, you would invest in one area for that particular scenario, and can make a good argument that that's a good scenario. At the same time, you could make a secondary argument that would be just the opposite, where they're not going to need to raise rates because American businesses figure out how to fix the supply chain and they figure out how to get people back to work, and then they overproduce. And this is actually a normal scenario where there's a big shortage of, let's say, cars, and all of a sudden, boom, there's too many cars. And we end up with this situation where there's sales, and that's anti-inflationary. Totally different situation than the scenario I just played out where the inflation was still there. So again, there's so many potential issues, and it's not the normal. Normally we have this kind of relatively standard scenario of a recovery coming out of a recession, and things are happening in a certain particular way, and that's not happening at all here. And there's a lot of surprises. It certainly has caught the Federal Reserve off guard as far as that goes. So here, bottom line, in this particular type of scenario, when you have so many different cross currents coming, I really think it's still best to have a broad exposure. Okay. And so even in our case with these 4 targeted pieces that we use, 2 of them are in broad market pieces, S&P 500 and total stock market index. I have 2 more targeted pieces. I'm buying like Apple and Nvidia, companies that I really like, that have great product and good demand, good cash flow, et cetera, et cetera. And so I do think that hopefully will play out. We'll see. I'll react to it if it doesn't. And so really, the other part for our portfolio, just so you know, what I talk about within our models is generally inside of our IRAs, because we can make these changes. We have, these trust accounts and individual accounts, taxable accounts. Those are handled a little bit differently. We still have some pieces from last year, that aren't doing as well this year, but they made so much money, it's hard to take the gains and, those type of things. So I'd still be holding on to those gains as much as possible, especially since we're right here at the end of the year. But altogether, I think a broad broad market approach is kind of the way to go here when you get this many cross currents. This is what happened quite a few times this year, and it is really, really happening right now as we speak. We're having a lot of different issues with, yesterday the Dow is great. Today, I mean, it's not so great. The NASDAQ 2 days ago was fantastic, and then it was awful yesterday. And then small caps haven't done anything. They're doing great today. So, I mean, you're going to be chasing your tail if you're trying to find these trends, because this is just such choppy water right now. So better off just kind of participating in the whole thing and seeing how that goes as far as that goes. So anyway, that's my outlook for kind of 2022, especially for the beginning of it. I'm planning on kind of coming into that year with this broadly diversified portfolio, and that's why. And we'll see what happens. I do work on that constantly and try to see what trends might transpire. So look forward to talking to you about again this at the beginning of January, and we'll see how things have transpired between now and then. All right, so let's get started with some of the questions.
Yeah, the first question is Fed says they're going to increase rates 3 times in 2022. Should I change my allocation at all, or should I keep my same allocation, maybe change what's in my stock piece or what's in my bond piece? Do we wait till there's actual raises before we make the changes, or we try to preempt the changes?
Yeah. Okay, so it's actually I watched Chairman Powell, the Fed governor, speak on Wednesday, and they're actually not saying they're going to raise rates. What they're referring to is this what they call the dot plot, and that's where each Fed governor guesses how many rates they might do, and actually it's sort of predictive of what might happen. But there was 5 of the 8 that said 3 rate increases, and 3 of the other 3 said 2 rate increases. So, the market's going to react to that and factor that in. But again, you could have a scenario where we don't need to raise interest rates. I mean, probably the most probable scenario in that regards would be solving supply chain issues and figuring out how to get, all of these products that people want out, and let's say that they overdo it, which is the norm. I'm telling you, this is once we finally do solve that, we're going to end up with too many cars, too many computers, too many graphic cards, all these things that are short right now. The shelves will be stocked, and they'll start having to have sales. They're going to over respond, typically, is what happens. And so if that happens, if you think about it, those are anti-inflationary situations. And the Federal Reserve hopefully keeps some flexibility in place, and maybe they don't even raise rates in 2022. Originally, going back to last year, that was the expectation, that we would not have rate increases here in 2022. So to kind of answer that question, it's a long answer for a short question, but really, I would be pretty cautious about trying to guess what's going to happen there, because I'm not convinced that that is the number one scenario. And I would stay with kind of a broad market approach. I would buy, VTI, ITOT, and those types of things that are broad market exchange traded funds, where they buy essentially all of the stocks, small, mid, large cap, growth value, you name it. And because as the market churns around, right, it's going to be very hard to make adjustments. So if you're trying to buy into things that you think would do well during this Fed rate raising, you could be wrong. But one thing I think will happen, I do think the market itself will go up as a whole. And very much like what we saw this year, the market went up as a whole, but the churning was ridiculously high. And so you still made money if you bought the broad market indexes, and could do much worse if you weren't, if you're trying to guess where things were going to go. Because there's just, again, this is not a normal scenario. It's very difficult to guess in advance where things are going to go. I'd definitely like to see more trends develop before I'd get involved in making, guesses and adjustments in that particular direction, in my opinion.
Yeah, so this question came in from Richard. You know, congressional or the 2021 congressional sessions have ended on the 10th. What are your thoughts on tax increases for 2022? When they decrease taxes, usually is immediately takes into effect. But what about tax increases? Does they have that same precedent?
Yeah, so I guess that question is essentially talking about, you know, if they change taxes next year and they increase them, will you have to pay that increase in 2022 or it will start in 2023? Historically, we've seen both, right? Where it's retroactive or it starts the next year. So that's impossible to predict. I will say something. I don't think taxes are going to change next year. Matter of fact, I feel really strongly about that. Currently, the Build Back Better program is the one place where they could change taxes. The House passed a version of that, and the Senate is having trouble getting that through. And they might not. It might look quite different by the time we get through. But when you're going into an election year in this midterm year, that's generally not something you're going to see. And but that the bill the House passed had no increases unless you were at $10 million or $25 million of revenue, or you were a corporation. Those three could see some increases, but for the rest of us, normal investors, we're not good. There was no capital gains increase in there. There was no taxable increase at all whatsoever. There was some kind of restrictions placed in the Roth IRA conversions, but most of those, at least from what I can see, won't have a big impact either. So all the talk that we had prior about, hey, they're going to raise capital gains. That's because that was part of the platform. That's not happening. They were going to increase the top tax bracket and actually make capital gains be equal to the top tax bracket for incomes above $1 million. For somebody selling their house, that would have been a huge deal. That's not happening, and especially not going to happen here heading into this, midterm election. It's not. It's not even on the table. So I do not see that. It got killed already. I don't see it just popping up all of a sudden and then somehow getting passed. These people aren't going to change their mind. And so anyway, that on the next Congress won't be in until 2023, right? The election is November, but they aren't seated until 2023. Things could change then, depending on what the power dynamic is and what have you. So I wouldn't worry too much about the taxes. I think that's off the table at this point in time, personally.
Cool. So this is a planning question. Should I take money out of my Roth to pay off my mortgage or pay off a car note?
Yeah, okay. So let's say you've got your mortgage and you're just trying to get rid of it. It's kind of an irritant, and you've got this money in a Roth IRA, right? So that's kind of the scenario. And you're looking at that. And one thing about a Roth IRA that's kind of ironic is that it's very easy to get money out of because there's no tax consequence. If it's in an IRA, and I pull 200,000 out to pay off my mortgage, you're going to have to pull probably 300,000 out to pay the other portion in tax. If it's in a, regular taxable account, if I have a big gain on that, then I'm going to pay tax on that gain. And that really hampers the ability to pay down that mortgage. Whereas with a Roth, if I have a 200,000, I can take 200,000 out, it's tax free, right? And I could pay off that mortgage. I would not do that personally. It is so hard to get money into tax-free growth, especially this type of tax-free growth that can be invested in the stock market. Um, I would not give that up. Matter of fact, we recommend that you leave that asset alone until the last time. Take your money from all of these other sources. Leave the Roth for the long term. First of all, it's a great inheritance. It's a better inheritance than most things. So if you don't use it, that's good for whoever your beneficiaries are. But irregardless, it still allows you to have tax-free growth. So if you're averaging 10% a year or something in your Roth IRA over the long term, that's tax-free. That's unbelievable. And to give up 200,000 of that and maybe live another 20, 30 years or whatever it might be, especially since these rates on mortgages are fairly low, kind of in that 2.75 to 3.75 range, depending on the situation. And I think, I would figure out maybe refinance if you're at that 3.75 range and try to get it lower. Use that extra money to pay to pay off the mortgage faster. There's a lot of different things that I would look at. I would really, really, really recommend strongly protect the Roth IRA assets that you have. Don't use those unless you absolutely have to. If you're out of money in other areas, that's what it's for. Use it. But if you have money in other areas and there's some other way to do it, then do that first. The Roth should be the very last thing that you take money out of.
So would you say taxable accounts first option, then maybe your IRA, and then last option is your Roth. Kind of
Yeah,
be the
in
order.
general, that's exactly right. As you know, it can be a little bit specific to people, but the general recommendation is the sequence of withdrawals is taxable, tax deferred, tax free. So exactly right. You'd go after your taxable assets first, if you have any, and then you'd look at your tax deferred assets again. But you got to be careful there because if you're under 59 and a half, that can be really expensive. You pay tax plus penalties. And so, there's a loan option that you can use against your 401k or something like that to get around that aspect of it if you need to. Um, Taking out a loan on your 401k to pay off a loan on your house doesn't make a lot of sense to me. But if you needed it for something else. But yeah, that in general speaking, that's the lineage. But that's why we're here. Honestly, these rules of thumb that people are trying to grab onto and do their own financial planning and their own work are difficult to apply to your specific situation, and you could make some mistakes, honestly, pretty easily by not knowing all of the things. And as you know, we've done over 6,000 financial plans and meet with the clients constantly, and so we've got this feedback loop that's coming. Hey, this is really working, and this isn't working, and that helps. And that's something that you pay for as far as that goes. And if we're doing our job, we're paying for ourselves. That's the key. It shouldn't be an expense to you to hire a financial advisor if they're doing their job. If their rates of return for us, we manage assets, are good, and then all of the other things, saving taxes, savings you from these tax time bombs like these big IRAs and things, we'll pay for ourselves, and that's why people stay with us because we do pay for ourselves. So that that's the object. That's what we try to do constantly.
Yeah, and usually we help you make decisions. You're not out in the dark guessing. And by having a live plan, we can test the scenario. We can tell you, hey, this is optimal, but maybe it's not great for your personal situation, but this may be another option that works well still.
Yep, exactly. Sometimes you need a professional. I would say, honestly, you need some money to make that work. Just because, if you're making mistakes on really small dollar amounts, like, hey, I have $5,000, saved up, and you make a 10% mistake and you're off $500, whatever. That could be taxes, that could be returns, it could be anything, versus say, $5 million. That's a huge differential, or even $500,000. So ultimately, what you do want to do is try to use, in my opinion, as much of this kind of free advice as you can as you build up your assets. But once you get to a level where those assets are higher, mistakes are much more expensive. And then it makes sense, because even at 500,000, if I make a 10% mistake, that's 50 grand. You're not going to pay me 50,000. So, I might help you avoid that mistake. And that's going to be better off for you as far as that goes. So there is a certain amount of dollar amount that you kind of need to really hire somebody. But yeah, I think professional advice is, well, I'm biased, obviously. But I think, we've helped with our clients a lot. We have a great testimonial page that really kind of highlights some of the things that we've done for clients, and people seem to really be excited about what we've done too.
Yeah. So if anyone has any questions, they can always jump in chat and just throw it in, and we'll
Yep.
put it into our hopper and answer them.
Yep.
And our next question is, you talked about your fruit tree method for kind of pruning these large stock positions. With that method, you talked about covered calls and how they generate income. Could you explain that a little bit more? And also, what's a covered call?
Yeah. Okay. That's a complex question. So the fruit tree method is just somebody who has a large holding in an individual stock. Usually it's because they work there, as far as that goes, but not always. And so you've got this big position. It's worth a lot. It's becoming a dominant part of your portfolio. There's some concern if something happens to that company that it would have an adverse effect to your overall financial health. And so sometimes what we'll do is we'll pick a target, some dollar amount or some percentage of assets. So I'll make up a number, say $1 million. So if it grows to $1.1 million, right, then we're going to prune or take off the fruit fruit tree there. We're going to take out that $100,000 and put it in something else, something more diversified. And so we'll keep it going. It just keeps that $1 million there. And that's the fruit tree concept. I think it's a cool concept. It actually allows you to continue to benefit from a company that could be fantastic without ending up with 90% of your money potentially in this one thing that then falls apart and now you're in financial ruin, right? So kind of bridges the gap. But then there's some strategies that you can use to try to kind of enhance even that. So now I've got 1.1 million. I want to sell 100,000. Well, one of the things that we can do there, which I really enjoy, you can put in a stop loss under that $100,000 worth of shares, pretty close, like just 5% below. And so if it drops a little bit, yeah, you'll get it. You'll get your 95,000. That's fine. And what you want to do then is maybe do a call option, a 30-day call option, maybe 10 or 15% above the price. And so I'll explain what that is in a minute. But in essence, what happens if during that 30 days your stock grows 10 or 15% in that time frame, you'll often be called away. So you might get 110 or 115,000. But whenever you sell that call option, you're also getting money. You're getting an income source. So theoretically, if that thing stays between the stop loss and the call, and you do call months after months, you can actually make money on that and still be protected on that fruit piece of that tree. So call option, in this case, what's called a covered call, is where you have the actual stock. So Apple or something. So I have Apple and I have $100,000 worth of Apple that is going to be my fruit that I want to pick off of this tree. And so I can go and sell a call option. That just gives somebody else the right to purchase that Apple at, let's say, 10 or 15% higher, than the current price. And that is a strategy that works out really well because it, allows that 100 to grow if it's going to continue to grow, still moving up that stop loss, kind of every month, and then essentially keeping that call option going month after month. And you can generate income off of that while you're waiting to sell that stock. Instead of just selling it, you have a chance, maybe you sell it, it's 150,000 and you've generated 5-6 months worth of income off of the call option before it finally triggers one way or another, either comes down and hits the stop loss or goes up and gets called away, right? That's an awesome strategy in my opinion, and it's kind of fun. It's an easy thing to do. That sounds somewhat complicated, but it's a strategy that is I think pretty fun to implement as far as I'm concerned.
So for the stocks in these like covered calls, are there any requirements? I know usually for a call contract, you need 100 shares at least when you do these contracts.
That's exactly right. So it works well for the fruit tree concept because usually we're talking about pretty big dollars, but exactly right. You need 100 shares to buy one contract. So for example, if you wanted to sell 50 shares, you couldn't do a covered call on 50 shares. You have to have 100 shares. So, and that's why it's kind of interesting with some of these stocks that have really high prices. Amazon and Google are a lot higher than, say, Apple. But yeah, exactly. That is one of the criteria. Generally speaking, in my opinion, you don't want to do that on a little teeny stock personally. There's just too much volatility. The call options aren't that liquid. But we live in Silicon Valley. I have yet to see a company that doesn't have a lot of liquidity here. NVIDIA and Apple and Cisco and Intel and eBay and PayPal and Square. And there's an awful lot of companies that have plenty of liquidity in their option market, at least here. We're kind of lucky in that way.
Yeah. So with Christmas coming up, a lot of us are thinking about giving gifts. And so what's kind of the best way to gift money to my grandchildren if I was wanting to maybe think about a larger sum of money than usual?
Yeah. I mean, you can gift up to 15,000 per person. So if you are married, you could actually give 30,000, to a grandchild. And if you're not, then just the 15. Maybe you don't want to do that much. You can always do less too. Those limits will, if you stay within those limits, then it doesn't affect your estate tax exemption. And so what happens there is there's a lot of different ways to do it. I think for the most part, what I've seen with grandchildren is something oriented towards college. I have seen with children, especially adult children, the children that have those grandchildren, for example, I've also seen cash. They just give cash, right? Every year they give cash. It's a way to kind of keep the state in check for people that have some excess money and they want their kids to get something out of it now and they need it. They got kids and school and those type of things. But for grandchildren, what I normally see, you're assuming they're younger in a lot of cases, it is cash. They can do cash, that's for sure. But oftentimes they'll contribute to a 529 plan. So a 529 plan can be used by the grandchild for college. And any growth that you get inside that plan is tax free as long as the money is used for college. And so that's a strategy that I see used the most for grandkids is kind of a gifting into this college fund. There's some disadvantages. What if they don't go to college? 529 plan can be pointed to somebody else. So if there's three grandchildren and two of them go and one don't, you could point the other one that didn't go towards the both of the other ones that did go. So that's kind of neat. There's a little bit of flexibility, but that's where sometimes the cash gift is a little better, depending on what you think might happen for that child in terms of college, or a combination of both, like a 529 and some cash, right? So, but it's fairly straightforward as far as that goes. If you do set up a 529 plan, then you can just keep contributing to it each Christmas if you wanted. And that'll be kind of your legacy, helping. College is expensive, right? And getting more expensive and growing at much faster than the rate of inflation. So being able to help with that is great. And so anyway, one other quick thing, 529 plans now also allow to pay for private school, like a private high school. So, and sometimes, your kids, if the grandkids are trying to go to there, they're having to pay for that. So, might be able to help with that through the 529 plan, especially if they're younger, and that might become later because then you get that tax-free growth for a longer period of time.
Yeah, going off that topic too. If you want to pay above that 15,000, there's some qualified expenses that you could pay for someone else and not be considered a gift.
Yeah.
And so, say they're going to private school and it costs $20,000 a year, and you're a single household essentially.
Yep.
You could pay if you pay directly to the school and bypass that grandkid.
Yep.
It wouldn't count against your gift. So
Yep.
you could do that to kind of exempt you there. And 529s are becoming more flexible. They're starting to include trade schools. So even if they don't actually go to college, there's still other options.
Yeah. Yeah, my kids went to Harker Academy, and they had Grandparents' Day every year because there were a fair number of grandparents paying the bill, and that's exactly right. That's what they can do, and because that's one way around that $15,000 gift. So that's a good point. Yeah.
So this is a question about long-term care. What is self-insured long-term care, and what are the benefits of being self-insured over a policy, just a standard long-term care policy, or a rider on a universal whole life insurance policy?
Yeah, that's a really good question, actually. It's kind of fun to dig through this. So here's how I look at it. If I take your financial plan and I run Monte Carlo simulation and it is successful, so it's at least 85% of the Monte Carlo simulation, success rate is 85% or higher. That's great. And then if I go in and I push the button to add long-term care costs, let's say you or your spouse goes into long-term care, costs X amount per year, and you go in for X number of years. And sometimes I'll be pretty aggressive with that. If you're still at 85% or higher on your success rate, even with that potential outcome, I consider that self-insured. It just means that your overall situation financially could absorb that scenario and still have a very high probability of success. So that's self-insured. Now, what if I push in the long-term care for somebody and it doesn't work? It drops them back into the 40% range or something, probability of success. What that means is that couple or person is very susceptible to the possibility of long-term care really, really messing up their financial future. And so those people need to be looking at a policy to kind of ensure that. It's the same thing. Got $1 million house that gets wiped out in some natural disaster. we insure those because it's kind of a big deal trying to replace that. And that's a big asset we're trying to protect, those types of things. So this would be one of those ways that you could do that, is to have that long-term care insurance policies. There's lots of different kinds. There's portions that have a whole life built in. They can go the other way. There are whole life policies that have a long-term care rider built in, and there's a million different ways of doing it. But first and foremost, figuring out whether you need it or not, I think is important. Now, sometimes I run into people, and it's not that uncommon actually, where they don't need it. They're self-insured, but they want it. It just makes them feel better, and they want to make sure that, if it happens to them, that it's just more insured. Now, these are people that can afford it because their plan is very, very well designed in terms of their probability of success is very high. And so I do have quite a few people that have long-term care insurance policies that don't need it, at least from a self-insured standpoint. But that's just sort of a different thing. They like insurance. They want to make sure things are covered. And a long-term care insurance policy can actually be a good investment if you actually need it. So, for example, if I had to pay $6,000 a year for 10 years, I paid $60,000 into that, and I had a long-term care insurance policy that would pay out $300,000 max, some kind of cap. I'm making these numbers up, but obviously that's a good investment. I put in 60 and then it paid 300 out. Right, that works. But as with most insurance, I've paid for lots of different insurances that I've never used, and I'm pretty happy with that, to be honest. But that could happen with long-term care also. I paid that 60 and then got run over by a bus. I didn't need the long-term care insurance, and so that but that's part of the picture. For those people that do end up using it, they become good investments in that regards. And so I do have some clients right now drawing off some long-term care insurance policies. They're glad they have them, and so that's an issue as far as that goes.
Yeah, and so peace of mind is really key when it comes to these kind of policies too. If you sleep better at night, paying that extra little premium for long-term care policy, that's worthwhile.
Yep. Yep. Yeah, I liken. I happen to have a lot of insurance myself. And it makes me feel good. And so I I have a weird way of looking at it. When I spend money to go to Hawaii, one of my favorite places, I go there because it makes me feel good. And I feel good when I get back, and I like Hawaii for whatever reason. And, it's the same thing with insurance for me. The insurance that I have, flood and earthquake and house insurance, car insurance, I have big umbrellas. I don't know. It just makes me feel good. And I know it's expensive. I probably, have been wasting my money to a certain degree, but there is an aspect of it that I think is important just from mental well-being. I like knowing that, what I have built up here, I can try to protect. And so long-term care insurance would be really trying to protect that asset base and or a spouse who is still at home, that kind of thing. So yeah, it's an interesting area, but it's a little bit personal as to how people look at that. And, everybody's a little different there.
So this is another question related to the market. What is a complete stock market cycle? And, how do you tell what part of the cycle you're in?
Yeah, so a complete stock market cycle is kind of from the bottom up to the top, back to the bottom again. So for example, I think we hit a bottom from the 2000 downturn about 2002, maybe early 2003. I can't remember exactly right now. But then we ran all the way through till October of 2007, and we hit a top. And then we came down all the way till October 2010. Not sorry, March 2010. And that is a full cycle. So where you had this kind of big run up, we had a very big run up that happened after the 2000 downturn, got all the way back and then fell and ended up actually in that particular scenario with the second biggest downturn in the last 100 years, second only to the Great Depression. I think market cycles are market cycles are most important to determine, how I'm doing. Because, how do I do on the upside? And then how do I do on the downside? And if you can do well at both, wow, that's really, really great. Because a lot of times super conservative people do really well on the downside. and then do terrible on the upside compared to the market. And then super aggressive people do just the opposite. They do really well on the upside and then get hammered on the downside, right? And so, can you maintain a rate of return that is commensurate with the market or better than the market, and then on the upside and the downside? That's a really big challenge, and that's one thing I think we want to look at with your advisors personally. How do they do throughout the different market cycles in total across those arenas? Our average client's been with us for 22 years, so they've got a chance to kind of see us through a lot of different cycles, and it's something I pride myself on. I'm sitting in front of these 6 screens right now as I speak, and the market's going, and I try to keep track, and I work on really, really hard to try to deal with both cycles. How do we do well at both? I'm not perfect at it. It's difficult, but it's a fun process. But that's what a cycle is, and I think that's what its importance is also. Just you have to be careful of just analyzing yourself or your advisor in one of those cycles, because they could be not so good in the other ones, and you still end up losing out. So that's important as far as that goes.
So this is a question that kind of commonly comes up with like someone that's kind of like the sole breadwinner of a family. How should I plan for if something happens to me, or like, I get into a car accident and I'm in a coma, how do I plan to keep my family going even though I'm not around? Or I'm still around, but just not working.
Yeah, so you're disabled and didn't die, because obviously if you're going to die from that car accident, then life insurance is the best way to make sure, as well as a very well crafted portfolio, as much as possible, saving money, those type of things. So when you look at disability, they have disability insurance, so that if you can't work, they pay you. I'm not that familiar with disability insurance, and there's one reason actually, because it's not that common. I think it probably should be more common. I have yet, though, in my 35 years, I only have one client who ended up in a situation with disability. So, that could just be random chance, to be honest. But that would be the thought process there, is that you might have a disability policy to protect your family from that potential issue. I think the other things is to try to really focus on the investment side of the arena. So what incomes would come in, irregardless of whether you could work or not. So, I've got a lot of clients with rental incomes, and so there's usually a manager working on those. And so if that income just continues to come, right? What type of asset portfolio do you have? How stable is that? How well crafted is it, so that it could maybe have some withdrawals from that asset base early, before retirement, so that you've got a scenario so that you can take care of your family that way. And then you have to take a look very closely at where you're placing that money. If everything you have is in, your 401k, then you've got problems, because now if you're maybe disabled before 59 and a half, although there is a disability waiver on most of these things where you can get money out without penalty, but it's quite taxable. So, having a spread on your assets, which is what I recommend, taxable, tax-deferred, and tax-free. I think it's very important to have a tax diversification strategy, especially in that scenario, because what's happening there is what you just did when you got disabled. Maybe it's temporary, but you just early retired. It's the same thing, right? And now, how does your assets handle that? And so, if you're really concerned about that, then building up an asset base in the proper manner would help too. Creating some passive incomes, I think, could help, and then obviously looking at disability insurance there too. Especially if you don't have the assets yet.
Yeah, and for disability, um, there's different types of insurance. There's one for like if I can't work at all versus I can't work my job that I was trained for.
Yeah.
And so that can make a big difference in cost too. So, but then also depending on your job as an advisor, it's very hard. Disability for us is if we physically are disabled, we could still possibly work and make it through.
Yeah.
But if your job requires a lot of physical and something happened, maybe you injure your back or something like that, and you're out, that could be a big difference. So
Yep.
looking at your occupation plays a
Yeah.
big part into disability.
I hurt my back, this year, as you know. I didn't miss a beat because, I don't need it per se in this line of work. It was a pain. But if I was doing something more physical, a contractor or whatever, or something along those lines, I would have had some troubles. Just, was having trouble getting around for a little while. Yeah, no, it definitely makes a difference as to the type of job that you've got and, what the injury might be and that type of stuff too. So. Okay, I want to thank everybody for coming today. Really enjoyed the process here. This has been a great year for this show. We've got some really good things planned for next year. Some things that I think you're going to be surprised about, actually, that we're working on really hard. And I look forward to, showing you those. And again, you can send in questions even during this break as they come up, and we'll cover them, that first show in January. You can schedule an appointment, at some point in time, just to sit with us or not, on video or phone right now for the most part, and we can kind of help you through that as far as that goes. And again, if you want to continue to get info from this channel, go ahead and subscribe and hit the little bell button you'll get notified when we put things on there. So, and we're going to continue to put things on during the break here. So I do a daily summary of what I saw happening in the stock market Monday through Thursday. That's not going to stop here. I probably won't do it on the Fridays because it's New Year's Eve and Christmas Eve, but I'll still be putting those out. So if you'd like to see those and notified, then go ahead and subscribe. So thank you very much for coming, and I look forward to seeing you next year, and have a great holidays, everybody. Thank you.